Lorenzo Di Mattia, Portfolio Manager e Ginvest Sibilla Macro Fund. What was the main difficulty in managing the portfolio so far in 2016?
2016, the main problem was the first quarter, basically January and February. In fact, the major mistake we made was not to cut exposure on time between December and January when the market opened suddenly down 4.5%. These positions obviously were profitable in 2015, which was a great year, but we should have cut the exposure much quicker than we have done. It wasn't easy because, again, the market opened suddenly down 4.5% and then kept gapping down, but we should have made a better job there. Now, another mistake that we made last year was not to participate in something that strategically we've been seeing and talking about for several weeks, and most of our investors know, was the rally in the precious metal sector. And that was due to tactical reasons. We were waiting for a pullback, which never happened, and so we missed the first 3-4 months of the rally. Then we were able to get back in around May and June, but that was a smaller move. The rest of the year went actually pretty well. We were recovering steadily since April, and if I have to find something we did wrong, perhaps not taking enough risk. We were worried about a bigger drawdown, so we were sort of prudent in taking risk once to recover, and that's our policy, by the way. So we obviously regret, since we got basically everything right since April, not to have made a little more, but that was our approach.
Lorenzo, European perception on Trump is quite negative. What's your view on Trump's impact on economy and on financial markets?
So on Trump, we had the same view since before and after, right after the elections, and it was a rather positive view, actually, net, because the perception of Trump as a persona is obviously negative because he's very emotional, and all these tweets and all the statements he makes. However, what's relevant for the market and the economy, the $18 trillion US economy, is not Trump as a persona, but is the team, the economic team, the Republican team that is in control of the House and the Senate for the first time since the 20s. And that's great news, because the issue was we always had either a Republican president and the rest controlled by Democrats, or vice versa, the Democrat president and the House or the Senate controlled by Republicans, and that led to nothing done. Now today we have Republicans, of which Trump is very emotional, and you can criticize him as much as you want. However, we have Ryan, we have Pence, and those guys have been planning a tax reform for many years, and we believe half of it, maybe 2/3 of it, will be implemented, and even if some protectionism would be attached to it, the net effect will be rather positive.
Talking about your expectation on 2017, which are your views, and in particular, how do you expect to implement them in the fund?
There are basically 3 asset classes out of 4 that are very interesting. The first one is the equity space, which still will see huge inflows in our view, especially Japan. So Japan is the main beneficiary of the reflation trade and of the strength of the US economy, which leads to a strong dollar. On the top of that, Japan has an improvement in corporate governance, and earnings are doing very well. And the yen has resumed its downtrend. It touched about 100 before the elections. It went to 118 straight, which is the trade we are positioned on, and we reduced, and now we're back in. But the yen will go, in our view, to 120, 125, leading the Nikkei to 22,000. So that's a pretty big move. It's about 15% on the index, another 10% on the exchange. Japanese banks as well will participate, and we're positioned there as well. European banks are still extremely cheap. There are political issues which we believe are going to be resolved positively. We don't think Le Pen can make it. It will be scary in the first round, but we don't think she will make it. And Italian elections will also be postponed likely to 2018. Obviously, these are two factors that we follow closely, and that's why, especially in these circumstances, you need active management in our active investing in our view. But our base case is that these will turn out to be non-events, and European banks will go up a lot, another 20-25%, and we're positioned there as well. Interest rates will go up in our view. The fact that there is positive growth, inflation globally and picking up, and bonds are so low. The bonds is at 30 basis points, treasuries at 2.4, JGB are at 0, Swiss bonds are still negative, are things that really don't make sense given the economic growth. The market has gone through a deflationary period for a long period of time. It's hard to believe rates are actually going up, but I think they will. And lastly, the dollar. The dollar is a theme that's been pretty popular in 2014, 2015, has worked very well. We actually participated. And today, a lot of people gave up on the theme. They think either that the dollar is too expensive, or it's nearing a peak, or that Trump has a weak dollar policy. We disagree. We believe that for simple reasons, the dollar will rally. So there is the classic policy divergence that will resume this year.